of landmark proportions. Representatives, economic representatives from 44 countries in the world were present to discuss how the new economic order of the world will be managed post the war so that peace may prosper. The conference lasted for almost a month. Landmark proportions. Representatives, economic representatives from 44 countries in the world were present to discuss how the new economic order of the world will be managed post the war so that peace may prosper. The conference lasted for almost a landmark proportions. Representatives, economic representatives. I'm sorry, I'm hearing an echo. Are you hearing the same?
Yeah, I think there was a momentary echo, but I think now we are fine.
Okay.
Yeah.
So, representatives, including from India, and though India was not independent then, but it was of economic importance, and a gentleman by the name of C.D. Deshmukh, who was the first ever Indian to be the governor of RBI, and three others of his colleagues represented India as well. And what was the discussion about? The discussion was, how are we going to manage the world's economy? Many things came out of the conference. So the conference was led again by John Maynard Keynes, but this time a very, very sharp economist and a head of Treasury of Secretary of Treasury from the US, Harry Dexter. And between them and the 44 country representatives, they created several institutions and conventions. The institutions they created, which survive and are of play a tremendous role in the world economy, are, for example, the IMF, and in those days, what was called the International Bank of Reconstruction and Development, subsequently renamed as the World Bank. Both these institutions were created at that conference. But what was also created, most importantly, was the exchange rate mechanism that we follow today, up to now. The current exchange rate mechanism that determines the rate change between different economies, different currencies of the world, was thought through and created by a model invented right there in that conference. And the most important part of that exchange rate mechanism was that the base rate was always going to be reflected in US dollars. That was what the US got out of agreeing in the same conference to fund all those 44 countries with money, soft dollar arrangements, support to rebuild their economies. What they got in exchange for that is to make the US dollar the reserve currency of the world. Way back in 1944. We are now 76 years later and 77th year running, and the US dollar continues to be the reserve currency of the world. That is how important that conference was. Even today, you only talk of exchange rates in USD versus the next currency, right? You don't talk about INR versus Japanese yen. Yes, we do trades in that, but the world's trades are determined in US dollar one side and any other currency on the other. Not surprising. Very quickly, the US dollar became the trade currency of the world as well. And of course, it fueled demand for dollars. Because if this was going to be the currency in which you would trade, every country in the world would want more of it, right? And we still talk about the health of our economy in terms of, oh, we now have $480 billion worth of foreign currency reserves in US dollars terms. Everybody talks of that, right? So it's become an important benchmark of how much US dollar you own. That, as you will see in my later discussion, became a very important landmark in the way the monetary policy of the world developed and how that affects our investment markets. To push the story along, everything was going fine, but given the way the US economy developed, it became a consumer economy. It would consume at a disproportionate rate to the rest of the world because they had the money, the economy was growing, the employment was growing, incomes were growing, education was growing, and the baby boomers was taking the economy through the roof. They needed to consume, and consumption led them to buy everything from everywhere in the world, and therefore they became somewhere between the 60s and the 70s an economy with a balance of trade stacked against them with a very wide margin because they were buying from everywhere in the world and they were pumping dollars into the world economy, which the world was lapping up because they wanted dollars. But over a period of time, this led to inflationary tendencies and it led to a slippage in domestic manufacturing and some kind of, if you like, a down cycle of the economy began. And when Richard Nixon became the president, what he inherited was an economy that was staring at high inflation. And when I say high inflation, I'm talking about numbers in excess of 15 and 17%. And that for a US economy, we don't hear about that today, right? We think India is like that, right? But the US was like that. And so Richard Nixon sat down and looked into his past and said, hey, how did the last guy pull the economy back to its feet? And he looked at Franklin Roosevelt's model and he said, I can do that. So he said, well, I'm going to give cheap money to businesses and I'm going to try and pull the economy out of its problems. But then he soon realized the same problem that Roosevelt ran into. He had no more gold to print more dollars. Now what to do? All the gold, you get no more gold to buy from somewhere, right? So Richard Nixon did the Alexandrian thing and he cut the knot and he said, to hell with gold. Who needs gold? I need dollars and I'll print as many as I want. In doing so, an important part of the Bretton Woods Agreement came to an end. And the world's countries were then free to no longer use the US dollar as a reserve currency. Right? This happened in 1971. But as luck would have it, early in the 1970s, petroleum was discovered in the Gulf of Arabia. And all the Arabs, all that they wanted in exchange for the petroleum was US dollars. Some of you who are as old as me will remember the petrodollars era. And then more and more petrodollars came into Asia, and the US dollars had a new life. It was again, now not only was it the reserve currency of the world, it was the only currency against which you could buy energy. So it had double strength. So Richard Nixon's move, though didn't pay off within his time as president, because as you know, he was impeached for other reasons. But much later, it began to pay off. And by the time President Reagan took over, he had a very clear task ahead of him. He actually raised interest rates. He raised taxes to curb inflation. Inflation was running in almost at 20%. US has seen interest rates almost in the space of 16 to 17% on those times so that they could fight the inflation monster, rebuild their economy. And subsequent to that, Mr. Alan Greenspan came into the Federal Reserve as its chairman. I think he stayed there from 1987 to 2006, almost 19 years, the longest serving Federal Reserve chairman. And he saw the economy beginning to take shape of growth. And he said, well, I can play this game. I'm going to give credit so cheaply to the US companies that they will be competitive anywhere in the world. And nobody can touch me because I own the reserve currency of the world. So he started to give money cheaply. And yes, the US corporates and the US economy began to take over the world. They began to turn the tide against the European and the Japs. And that's how the US dollar moved back to an eminent position. Why is this important to know? Because what's happening now has a direct linkage to the position of the US dollar. So what's happening now? Between 2000 and mid 2000s, in fact, some of you may remember that in early 2000s, in fact 98, 99, we had a mini internet boom where a lot of companies, startups were being funded, dot com boom, the first dot com boom, and money used to come out of thin air to fund them. Where was all this money coming from? It was all coming from the cheap credit being provided under the regime of the Federal Reserve run by Alan Greenspan. Companies were picking up money cheaply and funding whatever they felt like funding, whether it was going to make money or not. It didn't matter. If one out of 20 things made money, that was good enough. So that's the first time the world saw an unreality in the funding and startups of new companies. And we all sat back and said, is this for real? I mean, there are these three young guys, they have an idea, and somebody's giving them, $100 million to put behind an idea, and that's a valuation. $100 million valuation in 1998, 97 was of a decent sized company who had run good businesses with solid cash flows. But that began to happen. That was the first sign of that. Of course, that boom collapsed, but it didn't end there. The next boom came in the housing market, and we all know of it as the subprime crisis of 2008, the first global financial crisis that took with it several eminent banks and several other institutions. But it, it did not stop the funding. So, what really happened in the funding? Where are we today in the funding? Sorry, if you see here in 2008, when the first quantitative easing happened, this is all figures in millions of US dollars. So the lowest number is $1 trillion. It reached $1 trillion, and we all said, wow, the subprime crisis was of the order of 200 to 300 billion. You need $1 trillion to bail yourself out? This is not real. But it didn't stop. It went on in a hope to make things well for the financial markets and for people at large. Governments do these kind of things. The central bankers will keep funding, keep making money available so cheaply that it is impossible to say no to it. And then they get the QE2 came, QE3 came, post which some sanity began to arrive during the Obama administration, and between 2014 to 2016, it sort of started to taper, and there was a flat period. All the way up to 2020, when the pandemic hit, and then look at the rise. The $1 trillion looks like change, right? The US alone is running at excess of $9 trillion, close to 10 now. And it just got added $1.9 trillion worth of Mr. Biden's new package, new rescue package for the pandemic, right? How is the US able to do that? Go back to my last slide. Remember, it is the reserve currency of the world. People treat it as good as gold. They believe they must have more dollars. And I'll talk about that in a little bit. So, at least 4 times over the last decade, GFC has been attempted, or sorry, QA has been attempted by various. This is the US, but I'll show you the global liquidity in a minute. We are reaching a point, I believe, where the cost of not doing QE is so enormous, and the prospect is so chaotic that many of the governments and the central banks will not want to think about it. So they are willing to do whatever it takes to keep the economy and, the more importantly, the financial markets afloat. Next slide is total liquidity in the global markets is 91.5 or $91.2 trillion. That's approximately the market cap of S&P 500 now. And on the right, if you see, this is my estimate of what quantum of quantitative easing has been done by different regions and countries. US is 9 trillion because we know that because Federal Reserve publishes it. UK is 3. Europe is between 8 and 9. Japan is 4 and 5. Rest of Asia is about 3. China is the black box. Our estimate is 10, but if it's 20, who knows better, right? This is the volume of money sloshing around in the world, right? And it has to go somewhere. So it goes somewhere. What does it do? So what is the meaning of this? Why do governments invest this money? We all know that investment is nothing but delayed consumption. In a market economy, consumption is the reason for the economic activity, right? We do all that we do because we want to consume something nice, better, and even better. So, in order to consumption to happen, investment is first required. So tomorrow's consumption can be better than today, so you make an investment. So, what is investment but delayed consumption? It's a delayed form of gratification. So, if you look at the left side, and there's a company called Capital Dialects from whom I took this data, they've tried to estimate in different periods of time in recent years what's the quantum of US dollar billions invested. And if you look at the lower slide, lower chart, it's very interesting. In 1995, in US, $6 had to be required to be invested to grow consumption by $1. The US went all the way post 2008 started to rise. It went all the way to 12, $13, began to come down till 2019 back to 6. In a way, they got back to grassroots. But now, and that this chart doesn't show, is again turned the other way. China, on the other hand, is investing almost 14, $16 for consumption of $1. These are the world's two largest economies. They're pumping in so much money that if you see the bar chart on the top, you will see the balance growth of just US Fed. But if you see GDP added, it's finally become negative, which means for all the money that you're spending, you may not be creating more consumption at all. So are we reaching a point of breakdown of the system of QE funding? We don't know. It's worked for the last 12 years. We're going to find out at leisure, hopefully. So why do credit bubbles matter? So first thing is, when money is given to you cheaply today in the US at practically is in every economy in the world except India, practically at 0% official rate, right? 1%, half percent official rate. Inflation adjusted rate would be far deeply negative. If you take India alone, the the government yield is running at 10-year bond yield, which is the borrowing rate of the government. The prime borrower is borrowing at about, well, close to 6% or thereabouts. You and I know that inflation on the consumer end is well in excess of that, right? It may not be double digit, but it's very close to that. So in a real world, in the hands of the real people, what they're getting the money for is a minus 3%, which means it's like saying, borrow from me and I'll give you a 3% bonus to borrow from me. That's a negative real interest rate. So what happens if you're running a business and I'm running a business and somebody comes and says, hey, I'm giving you interest money on, negative interest rate. Not only you'll take the money from me, I'll give you 3% to keep the money. What are you going to do with that money? You'll do whatever the damn hell you feel like. When the next idea comes into your head and say, here is money, let me try this. Here is money, let me try that. Didn't work, what does it matter? That guy doesn't want it, right? Let me do whatever the hell I please like and give it to my son and my daughter and my driver and my maid and say, tumko jo karna hai karo. This money I'm getting to keep at 3% is to keep. So cheap money gets used for irresponsible enterprises. Economists call them malinvestments. These have been happening well before 2008. 2008 were a symptomatic outburst of sustained malinvestment in US housing, which burst open. So it's been happening for a while. And that's what happens to malinvestments. Beyond a point, they bust. Somewhere or the other, they go off the table. A lot of malinvestment may be happening in across the world, including India. Very difficult to judge. So, how do you judge what's a malinvestment and what's a good investment? Very simple. A business that can never deliver market equity return to its marginal investor. So, in India, if a business can give you 13 to 14% equity return, because that's the index return over a long period of time, then it's a good business. It's not a malinvestment. But if a business, because it's got money at minus 3% or 1% or 2%, and it can only make 6% and feel good, hey, I got money at 3% cost, I'm making 6%, I'm making a 4% margin. Sounds good. But when the marginal investor is used to getting 13% on his equity, 6% is not going to fly for too long. And that's a malinvestment. As that business will die eventually, unless it finds a way to raise its 6% to 13 or 14%. In the US, the long-term equity return, so this is measured from 1890, is 9.3%. So if a business is not going to give you 9.3% over some decent order of time, and you can decide how much is your order of time, well, it's going to be a malinvestment. It's going to die. Yes, in the meanwhile, it will create a lot of excitement. It'll look very attractive. It'll look very exciting. It may even go up in valuation tremendously. And we see that around all ourselves with these .com businesses, right? How many of them actually make it? One, two, they make it beyond the malinvestment line. Because that's when you got to develop cash flows. That's where you got to develop a business model that doesn't fail, right? So funding may be available, but 5 to 6% return on equity is not going to cut the ice anywhere in the world, actually. So where else are these malinvestments going? I started to notice this somewhere around 2008-9, that a lot of companies and tech companies, a very large, one of the world's leading brands in technology, was aggressively buying back its stock, continues to buy back its stock. And I said to myself, hey, something is wrong here. Why is this guy buying back his stock? Hey, he's getting money cheap, fine. But why doesn't he put that cheap money for the next big innovation? The answer is obvious. There was no next big innovation on the horizon for this company. So then, should I buy the stock just because he's going to buy it back and is going to make some alpha? Well, certainly I should, right? It makes so much sense. I must make that money. But should I hang on to it for a long period of time? The answer is probably not, because unless the company has good ideas to keep growing his business and put money in that in preference to buying his own stock, I don't want to have much to do with that company in my portfolio for long periods of time. But this is the reality. The numbers speak for you before you. In the US space, number of companies who continue to buy back their stocks, and these are estimates. The latest estimates is that this number is crossed $1 trillion because of what has happened in 2021. That's the way the companies are. They're getting money so cheaply. It's practically a throwaway money. Well, let's make our shareholders feel good about it. Let's give them a return on their investment. Let me buy back some stock. So, boom, the stock price goes up. Of course, you have to remember the people who benefit the most out of this are the people who hold the big fat ESOPs, right? So they don't just do it for charity, they do it for themselves as well. One of the interesting sidelines which I observed when I was studying who's buying stocks in the global markets, to my surprise, and this will come as a surprise to you, I found 32% of the balance sheet of the six big global central banks: US Fed, Bank of England, Bank of Japan, EU, which is EC, European Central Bank, and Swiss National Bank. 32% of their asset side of the balance sheet was US equity. When I studied this, the second largest owner of the Apple Inc. stock was the Swiss National Bank. Now, I scratch my head and say, hello, something is wrong here. These are the guys printing the money. And now they're saying, I'm going to print my money and I'm going to put it in the stocks. That sounds really strange. Is that what the central bank should do? Central bank's job is to make the money supply in a way that employment goes up and inflation stays down. It is not their job to support the stock markets. But it seems to me that has become their job because that's 30% of the balance sheet. Now, if they don't support the price, the balance sheet tanks. So there is an interesting sidelight happening over there. And so these are just observations. And all of you who thought that the subprime crisis crashed the US market, hello, good news or bad news, the way you want to see it. 2008, you saw that blip downwards. But all that money that has been continued to be printed after that has caused bubble in real assets, not just in stock prices. I showed you the stock market. In real assets, the money is coming and it's driving the US market to a new high. Why? Think about it. Sit back and think about it. Ever since, I would say, the year 2000 or so, or just about thereabouts, if you own real estate, your own house, for example, in any city in India, you probably multiplied your house price by 3 to 4 times easily, right? It could be more in some places. Now you think about, look outside your window and say, so what has changed? Why has my house suddenly becomes 4 times the price? I mean, has the neighborhood changed? Is there a great new railway system connectivity? Is there a set of hospitals, new schoolyards? What has come around this area to give it so much better pricing? Nothing. Not much has changed, right? So what has changed? It is all this liquidity that's sloshing around the world has come into your city, and the same unit of housing now costs 4 times as much. Supply has not gone up by the same value, same volume, but the money demand has gone up dramatically, right? And you also saw when the QE was halted by the US between 2014, 15, 16, the Indian real estate market became stagnant, right? No new demand, no new money coming in. So think about it. This has a direct correlation on our lives. I'm giving you US examples because data is easier to find there. This kind of data is not available for India, but I can tell you this is so true for India as well, and you know it. What bad investments are there other than that? Emerging market debt, which includes India, of course, and includes countries much worse than India. Indonesia and Vietnam and Philippines and all these emerging markets. Emerging market debt is supposed to give you high returns, right? Because it is, the markets are a little less reliable. All the way from 2000, except for the blip in the GFC, they have become more and more attractive. If you invested in 2000 in emerging market debt, you would make a pile of money by now, by the rate slide. But imagine a Malaysia or a Thailand issuing its debt at 3.5% and the US issuing a debt at 2. Does that give you a little bit of a worry that, hey, is there a differentiation here or not? I mean, Thailand should be pricing itself close to US. Are the rating country companies wrong? What am I missing? But what you're missing is nothing. It's a chunk of money that's come into these countries, and they want more and more of this debt, and they were making the debt cheaper to issue. Junk bonds across the world, what you call high yield bonds, right? This is in India would be triple B type of bonds, or double A and below, or A bonds. Look at the yield. The yield is like below 5%. The US government yield is at like 2%. Is that the only spread between the worst kind of bond and the best kind of bond? So what's the point I'm making? The point I'm making is very simple. Okay, this is another one. Non-profitable tech stock index. Look at the way it's shot up in 2020 and 21. These are companies that make zero profit, never made profit in their lives, but so much money chasing their stock. in search of, I have so much cash, what to do with it. So, what does financialization do? Intense financialization of this kind induces unsustainable entrepreneurial initiatives, and we saw that. But it blurs the lines of risk in our mind, and that's what I was telling you. Emerging market debt is almost as cheap as developed market debt, and junk bond is not so expensive. People can't, people cannot differentiate between good risk and bad risk when so much money is available. Past wisdom stops applying. So, for example, you take our own market, there are these fantastic companies that people used to rely on all the time. They were into, they were called defensive stocks. You could never go wrong with them. Always traded at PE of 40 plus. Now there is a P zone we are reaching, which will touch 100 soon. At 100 PE, what am I saying? I'm buying 100 years future profits of this company? How does that make sense? Is it going to last 100 years, the company? I don't know. But past wisdom does not apply. You have to think of it differently now. And you have to be extremely careful because you may never go wrong in buying a defensive stock, but you could go wrong in not buying the aggressive ones. And a lot of fund managers made that mistake world over and quickly learned that they have to learn to take risk when risk is not easy to measure and make some money for themselves and their investors. Extreme greed and extreme fear accelerates the cycle. Even as we are investing in the market now, and 2 years ago, 1.5, 2 years ago, I had made an observation looking at the movement of the market to a lot of people like yourselves, and I had said then, well, I see the Sensex at 50,000 in a year and a half. Frankly, it was a judgmental call. It was not a prophecy. We are here now. And do I see it at 60,000 soon? Well, I do, very honestly. I mean, look at the quantum of money. It's got to go somewhere. And it's going to come into this market. What order of time? Not, I'm not going to really commit to that now. But it'll get there soon enough. It's only a 20% rise. Think about it like that from where we are today. So you so the cycle moves faster. Between 50,000 and 60,000, there'll be an up and down cycle that will happen 20 times. Which side will you be caught on? That's tough. Earlier, we had a thumb rule. Indian market goes from from top to trough and back in 3.5 years. I'm no longer willing to say that. Frankly, I do not know. I'll just have to pedal along and see how it goes and make sure that whenever there is a fall, I'm in the market playing with some stock to see if I can buy it. So, in a sense, watching the market has become far more important today because you could lose money in a couple of days and forever. And that particular stock may never come back because it was a darling of the market for a week and then it went. What it has also done at corporate levels is shifted the zone of control, what you call locus of business. Businesses used to control their customers. They used to be going after maximizing profit from their customers. But now they focus more on the shareholder. You think about how much money the shareholder is going to make. Am I going to give him a good return? Is my stock going to be among the darlings this week or next week or the week after that? That seems to occupy people's mind. But there is an upside to this also. Remember, when there's so much cash, are you surprised that there is so much innovation? This volume of money in this country alone, in your lifetime and mine, has given rise to three generations of entrepreneurs who are all younger than us. And they're successful. They have ideas, they're getting the money, they know where to put it. Yes, 1 out of 100 will be successful, but they'll get a better hit rate if the money keeps coming. Technology, lifestyle, health, entertainment, education. Look at what's happening there. It would not have happened but for this financialization. So while on one side, in the financial markets, the investment cycles are far more treacherous, but in real life, well, it feels good to know that we can do these things, right? We can be a better country with more entrepreneurs going chasing better things of life. And then lies the question of how does it all end? How does it change? Again, as a student of history, I can share with you the reserve currency status does not last forever for any currency in the world. And that shows you where it was at, or different years, or different periods in the modern economic history. A lot of people talk about is this the end for the US dollar? Well, we'll only find out. I'm hoping that we will not find out in our lifetime, because the end is never really pretty for anybody. The currency cycle ending is bad for everybody in the world. But we'll see how it goes. So it does not end well. Uh, Typically, what happens is when you start losing your faith in a currency, people start to look for real assets to hold on to. It's called a crack up boom, which means people start chasing anything physical. People start investing in real estate, in gold, in anything, in commodities, which are real, which they can hang on to, right? Which are there, and paper will vanish, right? So they do no longer like that hold on to that paper. They want something real, and that leads to a very high inflation in the prices of commodities and real assets, extremely high, and that's driven by fear of being left out of that asset rather than any desire to make money, right? And that's called a crack up boom. It's happened several times in the history of the world. Loss of faith in the monetary systems and emerges new currency orders. A lot of people tell me it'll be the yuan. Well, jury is still out on whether China can really float its currency to become a worldwide currency. We don't not really understand fully their internal debt problem, their banking system issues. Whichever reports I read, I seem to get a lot of discomfort rather than comfort. There is a Bitcoin. Interesting animal, this Bitcoin. And the question to ask about Bitcoin, because I know you somebody will ask, is what does it really represent? So let me tell you what is a currency. Currency is legal tender which allows you comfortably to choose what you want to do with your wealth, whether you want to buy X or Y. So this is a wire medium. The currency must be a legal tender and therefore must have the sanction of the government. So far, two systems of currencies have existed: commodity currencies and fiat currencies. Commodity currencies are the ones where a specific commodity was assigned the role of a currency, and for the history of the world, for the longest period of time, in excess of 5,000 years, that position has been held by gold and to some extent by silver in the shadow of gold. But when it comes to fiat currencies, they came about somewhere in the early 17th century, thereabouts. Started with France actually, and fiat currency is a currency determined to be so by a fiat or an order of the government. And for better or for worse, they chose paper. And paper currencies therefore have flourished, but they have no intrinsic value. Commodity currencies have intrinsic value. They represent value to the owner, right? Gold has value only because it's dug out of the earth at a certain price. It's rare. But most important of all, it never deteriorates in value. Whatever gold has been ever brought out of the earth in the world still exists in its form. It does not rust, it does not oxidize, it does not fritter away, and therefore it's called the noble metal. And that's the reason why over centuries and thousands of years it became the currency. Does paper have value? No. Paper only has the value the government assigns it, right? In fact, it says it's an IOU of the government. It says over there, I promise to pay the bearer a sum of rupees, so much, right? On demand. So what is that? It's an IOU of the government. Same as in my book is the same as the government bond, right? It's the same government issuing it. But it has worked because there was a cross linkage. What is a Bitcoin? Whose obligation is a Bitcoin? Will the government honor if you Bitcoin issued by some XYZ company, take it to government of India and say, hey, I want money for it. Will the government say, yes, I will honor it? The answer so far is no. Some countries of the world are saying, well, you want to trade in it, you can trade in it. Don't involve me as a government. I will allow it, but I will not be a sanctioning authority. China has gone one step beyond and said, I will issue it and nobody else in the country will issue it. So I will be responsible for this. So maybe their case is a little stronger, but a Bitcoin is issued by somebody. And then it's a question of, do you trust that somebody? The last time around, I found that these people who issued the Bitcoin with the hand in the till, they were on the sly issuing it for themselves. That's one part of the Bitcoin. But there's a very more important part of the Bitcoin. Who really wants a Bitcoin as currency? So what are the features of Bitcoin which are unique? Number one, who owns that Bitcoin remains invisible in the Bitcoin system, right? It's a distributed ledger, it's secure. If I buy Bitcoin, nobody else can know I bought and how much I bought until I disclose it, right? It is also a system which cuts across geographies, disregarding barriers of currency exchange and legal barriers and tax barriers, right? It just moves on the viral network, right? You can pay people in Timbuktu and you can pay people in North Pole or you can pay people in Wall Street. And no government is wiser or otherwise, right? So it is required by people who need to stay invisible. It is required by people who need to ignore international boundaries for their own purposes. And it is required by people who need to move tremendously large volumes of money in short order. Sit back and think about it. Do these people sound like they are into some legal business? They want to stay invisible. They want to ignore international boundaries. They want to move large sums of money quickly without a trace. I think it doesn't sound like a lot of people who you want to give your wallet to trust. So, not surprisingly, arms and ammunition dealers, drug dealers, terror funding could easily be done using Bitcoin with no government being wiser. So when you put your hat in the ring and say, I want to buy this, I want you to be aware that who are your soulmates in this pit? Who are you dealing with here? And and when was the last time anybody used the Bitcoin as currency to pay for something? As far as I know, people are just buying it as an investment. And what value does it represent as an investment? When you buy a house, it represents those four walls and the building society. When you buy gold, there's an intrinsic value. When you buy a dollar, it's got power to purchase X number of things globally, right? Bitcoin is issued by somebody suspect, used by somebody suspect. And if you're going to look at it as an investment, you better be sure what you are investing in. So, and for my money at this point in time, unless there is greater government sanctions and greater legal clarity, I would stay far away and I would think it's a long time before it becomes the legitimate currency of the world. But can it become the illegitimate currency of the world? It already has. It is already the currency of the dark world. There's no taking away. It's there. You can't move it. You can't take away that fact. So, are you going to participate in that or not? Each country, each community, each government will decide. How does all this affect us? The big macro risk that the world is facing is low interest rates, which lead to incentive for perverse debt issuance, overconsumption, and malinvestments. It is true for debt issued by governments, corporations, or even households in some places. The big issue for the world is because USA emits its own currency as the largest borrower, and the rest of the world takes in this emission as a reserve currency It allows the imbalance to persist for long. History has shown that whenever reserve currency issuer has abused its status, sooner or later it loses the status. As the world, are we prepared for it? We are in a muddle. And as we are in it now, a case cannot be that it cannot sustain forever. So what will it lead to? It will lead to monetary inflation, goods and services inflation, and maybe deflation. Impossible to say what. So it is important to choose correct asset classes. So I'm going to come to, is it 1 year or 10 years away, this blow up? Who knows? Is it going to happen? I can put my hand on the heart and tell you it is going to happen. 6 times previously in the history of the world it has happened. Very few people know that the French Revolution, the chief cause was exactly this. That they moved away from gold into paper currency and issued so much of it to finance their different wars with different countries that it lost meaning. A bag full of the currency would buy not even a loaf of bread. And then people said, this is it. We've had enough. And that led to the revolution, and Louis XIV lost his head literally, and so did his wife, I think Marie Antoinette. You don't even realize that this is what was responsible for the huge collapse in the Japanese economy in the 1980s, which rapidly expanded credit to fund the growth of its economy and all its keiretsus, the big industry houses across the world through cheap money. Right through 60s, 70s, and the middle of the 80s, it came to a halt. Hasn't looked up. Japanese economy has been completely at a standstill for 35 years. So this happens time and again. What will happen this time around? We have no idea. But yes, the end will come. So what do you do? As somebody who's been in this market for a long time, my simple advice to you would be build two portfolios. Portfolio number one, you must not miss out on the aberrations and the mispricing of assets that gets offered because of these problems and makes you money. Right? It's making everybody money right now. Who's losing money? Nobody's losing money. It's all going up. So please, बहती गंगा में हाथ धोना जरूरी है. Make a portfolio that will allow you to do that. Take the short-term risks in all the assets because the money is going after all the assets, right? But please create a portfolio number two, a nest egg that is Holocaust proof, for which you will have to develop a better understanding of real assets, because that Holocaust portfolio has got many pieces. I, for myself, call it the cockroach portfolio, which means what? Do you know the cockroach is the only animal that survives more or less in its original form for 1 billion years? It can survive a nuclear holocaust because it modifies itself very fast. It is death proof. What are the elements of this? Every asset in equal measure. You could have equities, highest quality equity, highest quality debt, highest quality cash, and highest quality real estate. You take your percentages. For me, it's 25% each. You will have to define what is highest quality. The highest quality is that which will not go bust when the reserve currency status goes away from USD, right? So which means what? Equities of companies that will not need capital markets to continue to pump cash flows from their business, right? I'll repeat it. Equities of companies that will not need capital markets to continue to pump cash flows from their business. Debt of the same companies is highest quality debt. Third, highest quality cash. In my book, highest quality cash is gold. The world has treated gold as cash forever and ever and ever. Now, don't make the mistake of ever thinking that gold is an investment. In my mind, gold is your insurance policy against all the other assets. That 25% will make up for the 75% if you lost the 75%. If you lost all of the 75%, the 25% will become equal to 100 or more. That is the nature of gold. It rises sharply during crisis. You saw that, right? Went up what, 40% in a matter of less than a year. So treat gold like an insurance policy. Don't put money in gold and say, hey, इसमें डबल हो जाएगा 3 साल में. It is there. अगर वो बाकी गुल हो गया ना, तो this will quadruple. That's the way I would say look at portfolios. And I'm going to stop here. I think I've spoken too much. And I'm going to invite questions. So any questions you have, please ask. Let me see how I can stop sharing.
I think I can just control it from here.
Yeah, if you can please stop sharing.
Yeah.
Great, thanks. I hope that was meaningful to some of you.
Well, to me, it was one of the most interesting presentations I've heard in a very, very long time. So thank you. In the interest of time, what I would do is I would ask the questions that I have. And in the meantime, people can post their questions in the chat box. And if they're interesting enough, we'll take them too.
Absolutely.
So I think, I'm just going to ask questions from your presentation. So you said that, and for a very, very long time, we faced this scenario where money has been available cheaply. So I want to ask, is moral hazard the new norm, whereby money has been available cheaply and more for every day? So is moral hazard the new norm? Should I go out and take as much risk as possible and not worry about what is going to happen?
So like I said, the upside of money being available is that you can take entrepreneurial risks that you could not take earlier. I wouldn't call that moral hazard. Moral hazard is on behalf of the central banks, that how far will they keep printing money, and do they really know when will this collapse? So let me give you a different side of it. Something that's worried the world more recently in the last 1 year than it did in the last 12 years. So when the quantitative easing happened in the last 12 years, most of the money actually went into the asset markets. Because who did the money go to? The Fed Reserve, the European Central Bank, the Chinese banks, Bank of China, they printed the money. And what did they do? They took over the stress assets of the banks. With that. So in a way, there was a transfer of money from central banks to banks.
Correct.
And they're going to the institutional system. And the institutional system spread it all over the world, trying to make the maximum return from that money by investing it in all kinds of assets across the world, right?
Yes.
But this time around, the money is being given by checks being sent to households, right? This time is helicopter dropping of money. When you do helicopter drop of money, there's an even chance that somebody will spend that money and not save it and put it in the investments.
Correct.
So 50% of the people will at least say, hey, I didn't get my salary check this month or last 3 months. I need this money. I'm going to spend it. Remember, we are living in a time when the GDPs of the world are collapsing and not rising. Simple inflation economics says that if GDP contracts and supply of money increases, is going to cause inflation. And the inflation at what is known as goods and services inflation is what we are looking at now, which we didn't have to worry about last 12 years. That was asset price inflation. This is goods and services inflation. Goods and services inflation has a very different impact on an economy. Asset price can be ring fenced to some extent, but goods and services can't be ring fenced. It impacts the government's ability to raise taxes. It impacts the government's ability to do any good, spend money to create employment, because already inflation is high, and then you do fiscal deficit financing, inflation will go crazy. Right? So this helicoptering of money is what is worrying a lot of people, saying that, man, this time around it is different. And therefore the moral hazard is there.
Correct.
It's not in whether you should use the money. Money is somebody's giving you cheap money, you must use it.
True, true, true. I think there's one question from Rakesh Chaudhary. He said, you said excess liquidity leads to malinvestments, but can it lead to efficient businesses becoming very solid, financially strong growth behemoths? I think we've seen this as an
Oh, yeah,
example
yeah,
in.
yeah. So I didn't mean that everybody only throws money at junk, right?
Correct,
If you're a smart entrepreneur, you will take that money and grow it, you know, boom your business. But you have to remember, you must meet the cost of equity expectation of investors. So if you're
hmm,
going to use that money in India and start giving people equity returns of 4 or 5%, then my friend, you're not building a behemoth. You're building a mal-invested business.
correct.
You must try and use that money to create the arbitrage between the cost of that money and the desired cost of equity.
Hmm,
So long
hmm,
as you're doing that, you will use that money very well. There's no question at all.
absolutely,
A lot of
absolutely
people have done that. A lot of people have done that.
true. So I think you also one interesting point that you made is we are looking at 100p businesses. So I remember I listened to a speech by Jack Bogle in the 70s. He said that there was a boom and then markets came back to their normal P, which he said was 12 to 13 times for the S&P 500. Today, if we talk about the normal P for Nifty, it is around 17, 18, 19 times. But if you look at the current scenario, and I'm saying normalize, I said that assume that COVID would not have happened. I think Nifty at current valuations would trade around 25 to 30 times. Please correct me if I'm wrong. So is this normal expansion of PE over periods is what we are seeing, and will we continue to see this?
Uh, so long as there is liquidity in the market, you will see expansion of P. It's as simple as that. Look, the market finally, for a variety of reasons, they trade, right? But
Correct.
fundamentally, it's a question of demand and supply of the security and the money,
Correct.
right? At the grassroots, that's what it is. If more money is going to chase a particular security, nobody's going to stop and say P is 100 or 200. I want it because it's making money, boss. It's as simple as that. P is a outcome indicator, right? And people
Correct.
use it, try to use it intelligently. Of course, the fact is it doesn't apply to most of the businesses, right? Financial business, it doesn't apply. For commodity business, it doesn't apply. So, but people still use it as a yardstick. But I'm saying you don't stop to think what P is it trading at. You stop and say, is this going to go up from here in the next 7 days or not? Or next 10 days or not? My horizon or not? That's all you worry about. It's about how much supply you're seeing and how much supply of money you're seeing. That's what you finally, it's your important indicator of trade. So I wouldn't worry so much about P multiples in this market.
Sure. Sure. Uh, so I just want to take your view on the growth rate that India or Nifty could have. Uh, a ballpark figure or a number that you have in mind.
I said, I am not tracking the Nifty so much, but to me, Sensex will be at 60,000, and I would think it won't be a very long time before it reaches there. That the only caveat I would say is inflation needs to be watched in the US,
Okay.
because if US gets inflationary, the money supply will squeeze. So this is
Sure.
driven by money supply, right? So that's what I think. I saw a question something about helicopter of money, and you think it's probably smarter thing to do than put $16 to try and develop $1. It's a hard choice, very honestly. What governments prefer to do is make people earn their money, because that produces GDP of some order, and that contains, every time GDP goes up, it contains inflation and gives you power to infuse more money into the economy. The moment you helicopter, it has done, people have done nothing for it. So GDP is not gone up, money supply has gone up, 110% is going to be inflationary.
Okay. I think there was a raise of hand by Rakesh Chaudhary. If you have a follow-up question, you can go ahead.
Good evening, Mr. Bishnoi. Actually, my question is exactly what you answered right now. So during these times of crisis, if governments have to or central banks have to resort to some sort of stimulus or quantitative easing, what do you think is the best form, if not helicopter money? Because earlier somewhere you stated that governments are spending $16 to drive $1 of consumption.
That's in China. Yeah.
Yeah, and then obviously consumption has its own multiplier effect because
Yes.
so I'm just trying to figure out that there has to be some kind of quantitative easing for the world to come out of these unprecedented crises, if
Oh,
one may call
absolutely.
them that. So what is the best form of doing that? I mean,
Like,
1929, the US government tried to build roads. I don't know where we are today on that.
no, no, so I'll tell you something. You took words out of my mouth. You know, we as a country are so uniquely positioned. Okay. Normally you should say that by now I wish we would have developed much more, etc. It's a blessing in disguise that we are not, because this is the time we can pull the country out of all its problems by investing in infrastructure. We need to be the road building country now. And I think from what I saw in the announcements made in February earlier, I think there's a good sense of purpose over there. Then let's put money, because infrastructure creates the longest term employment opportunity. Plus, it's a great accelerator of other economic activity. If we can start moving money into that, then I would say this opportunity is a fantastic one. And I think the world is beginning to recognize that, hey, infrastructure, where is the infrastructure growth going to happen in the world, do you think now? And on a scale that can't happen in any other country. India, right? You can go build infrastructure in Vietnam and you're done in a year. In India, it's a scale of operation. And that's where I think the tremendous employment opportunity exists.
Thank you for that. That was actually what conventional wisdom states, but unfortunately, we are seeing a lot of what
Well,
can one say, contemporary
you
wisdom
know,
floating around now.
it is not easy to navigate a ship like India. I would say that I don't envy any government in India. It's so tough. There are so many, interest groups. There are so many pressures and pulls. But if we can even move in that direction, I think it would be a tremendous move. I mean, if you just sit back and think about it, even from the time when I was a young man and I lived in the same city, practically in the same neighborhood for all of the last 45 years. I mean, today I can pick up my car and drive to Pune in 2 hours. And when I was a student in Pune, I recall Mr. Bajaj had actually thrown a gauntlet that if anybody can find a way to get people from Bombay to Pune by road in a couple of hours, he was then willing to give them a prize money of 1 crore. In 1981, it was a lot of money. And look, we don't even think about it twice. We're already saying, now this expressway is too little. We need more. We're talking about driving to Delhi in 10 hours. And it will happen, I'm sure. So things do change. I remember the first time I took a flight when I was a trainee, somebody had to urgently be given something. I was playing courier. I went from Delhi to Bombay and I paid a princely sum of 13 or 1400 rupees for my ticket. Today, the Delhi to Bombay air ticket costs 3,500 rupees. And I think about it and say, how the hell did that not go up? By all inflation statistics, that should have been like a lakh of rupees. So there are some things that move we don't realize that yes, improvements do happen. Of course, not at the same pace that it would happen in other parts of the world. I agree. But I'm hoping that it will actually move faster now.
Thank you very much. I think the macro insights that you provided have been very useful. Thank you.
Thank you, Rakesh. So I think in the benefit of time, I'd like to just ask one question, which I think will be beneficial to all. I want your view on which asset class would outperform. If you think it's equities, what within equities would outperform in the medium to long term?
So I'm a diehard optimist on equities. Okay, I came to this business because my mentor in those days, because of whom I joined the business, told me very clearly that look, there are only three ways you can get rich in the world. You have a great technology idea, you have a great entertainment skill, or you play in the stock market, right? And obviously, I had none of the other two. So I know we don't give it much chance. Sometimes we get nervous, but staying the course in this market is going to pay off. And I think we're pretty much, I would repeat that even now. Yes, we have to worry about the macro. We have to plan for it. Like I said, two portfolios will be better than one. Today, because of the financialization, I would say you should not stop at equity alone. I would want to pull in a insurance policy on that with gold, because I don't want to lose all the money in equities volatility. So I should have enough gold to cover for the eventuality, like an insurance policy. Real estate, I don't understand very well, quite honestly. But from what I have seen at this point in time, it is coming out of its slumber in India. And this is a good idea to look at it. But from what I've learned, highest quality is what will pay off. So the most premium that you can find and afford to invest in, because those will pay off for sure. Even in the complete morass of the market, you used to hear about deals, right, in South Bombay.
Yes, yes.
Premium will pay off, but I don't understand it well enough to say, what really you should do. But within equities, my own portfolio is constructed with 50% extremely high quality stocks. These are stocks I don't have to think about. They've been in the portfolio for 20 years. They will be there for the next. The remaining half is comes out of the mid and small cap. We have to keep looking at those companies. I am a little bit of old fashioned. I keep looking at companies, even if they don't have tremendously strong cash flows, are they on path to get there? I believe that unless over a period of time they deliver cash flow driven returns on equity, then it would be just a flash in the pan. I am not a flash in the pan investor, but you could take a chance on some of those because some of them flash very bright, right? And but you have to then stay nimble footed enough to get out in time. Or even if you don't get out of the peak, be sure that even if it's come down a little bit, don't get hung onto the peak in your mind. You are in money, take your money and get out. So there is this market currently offers a lot of trading opportunities. It will continue to. I am by habit and behavior not a trader, but I look at that and I sometimes envy those guys. As a mutual fund investor, you're not even allowed to be a trader much. But yes, this is what I would do. I think as you develop more wealth, preservation is more important than return.
Absolutely. I think Schwarzer said that there are no brave old men in finance, which I
Absolutely.
think.
So I think my approach would be this is the way to play it.
Sure, sure. I think it's been a wonderful time talking to you. I really hope that we could stretch it probably for another hour. It would be great. But I think in the interest of time, we'll stop it here. And I'd like to heartily thank you on behalf of all the participants for giving us this time.
Thank you so much. It's been a pleasure to talk to you.
Thank you. Thank you, Ashutoshi. Thank you, everyone, for joining the